As a result of these, when the crisis hit, we know as the Great Depression, the Federal Reserve did not act well and was put to the test. And afterwards, there was a series of reforms proposed by Roosevelt and a commission he put together. And the idea is to create a small body that would basically insulate it from political attack, but also be able to make the tough decisions in the time of crisis. So the governors are nominated by the president. They have 14-year terms. The idea of this was to insulate them from political manipulations that are inherent in our type of system as far as that goes. You're also nominated by the president, then you're confirmed by the U.S. Senate, and the chairman is nominated by the president from among this group, and then confirmed by the Senate also. The chair can be renominated every 4 years, and the FOMC, which is the Federal Open Market Committee, is the group that mainly puts together monetary policy. So you take 7 board members from the governors, and you take 5 presidents from the 12 districts, which will rotate, and they'll meet every 6 weeks or more often if there's a financial crisis. The 3 tools of monetary policy are very straightforward. In the open market operations done by the FOMC, which consists of buying and selling securities, then we also have what's called the discount rate, where member banks can actually borrow directly from the Fed if necessary. And then they also have what's called the reserve requirement, which is where banks have to keep at least 10% of their reserves in the bank or in the vaults in times of crisis. Now, this gets a little strange in this part right here, and every time I teach it in economics, it's one of my favorite things. We actually create money out of nothing. And I know people always hear that and they think, well, that's a recipe for disaster, which you could probably argue it is. But the bottom line is the Federal Reserve has the power to shrink the money supply, to manipulate and fight inflation, or they can expand the money supply to basically boost the economy. But the bottom line is they have the authority. They do not need the approval of Congress. They do not need the approval of the president. But the bottom line is they have the ability to make these decisions on their own, and it's a very powerful institution which not only affects monetary policy in the United States, but on a global basis. So we basically target a 2% interest rate called the federal funds rate, and this is a very simple way that it works. So if the Federal Reserve decides to buy securities, what they're doing is they're going to pump money into the economy. By basically doing this, they're driving interest rates down. And those interest rates aren't just for going to a bank. They also trickle down to companies like Best Buy, other companies, anybody that's using any kind of consumer interest. So this is a situation where you find the power of the Federal Reserve. And then we already talked about the reserve requirement and then the discount rate as far as that goes. So the Federal Reserve is a very unique body. At the time right now, we've already referred to the fact that it's a money machine. And it's also very controversial right now because the President Trump, believes he has the power or at least the authority to remove members of the Federal Reserve, which is one of the #1 fears that existed at the time of its creation. We survived.